And as soon as I'm done here, we're going to go outside and play some ball. He is very excited for that. So if it's your first time watching Liberty Call, thank you. I'm glad you're here. And please give him some thumbs up, likes, shares, subscribes. And see you on today's docket. We got the weekly economic update. Got today's market recap. What's going on with the mortgage fees? You've probably seen some news about mortgage for those with good credit are going to be paying more potentially than those with bad credit for lending. And then real wages continue to fall. So that's excellent news. All right, let's go ahead and jump into the numbers for today. Dow Jones was up 0.2%, 66 points, closed at 33,875. S&P 500 was flat, up 0.09, closed at 4137. NASDAQ was down 0.29%, closed at 12,037. The VIX was up 0.12 today. It's at 1679. Canada was down 0.08. Brazil was down 0.46. Mexico came in up 0.95% for the day. Heading over to the European markets, Germany was down 0.11, UK was down 0.02, France down 0.04, Netherlands up 0.04, Spain up down 0.1%, Italy down 0.75%, Switzerland up 0.06, and Portugal down 0.03. Russian exchanges were mixed today. The MOEX was down 0.17, the RTSI was up 0.16. And the overnights in Asia see quite a bit of red. Starting out with the Nikkei in Japan, it was up 0.1%. Australia was down 0.11. New Zealand was up 0.8%. The Shanghai in China was down 0.78. The Shenzhen Component down 1.17%. China A50 was down also 1.17%. DJ Shanghai down 1.04. Hang Seng down 0.58. And the Taiwan weighted was up 0.15%. All right. So it's strange. It just seemed like the markets were kind of, up, down, and really couldn't get a sense of direction on where it's going today. And, probably a lot of folks are out there waiting to see what's going to happen with, the earnings reports that are coming out this week and, see, is there good news or bad news? But we shall see how that goes. All right. Next up on the docket, we got the weekly economic update. Oops. Why'd I do that? Let me shrink that back down. Reset. All righty. All right. So the week on Wall Street, stocks remained resilient last week amid mixed earnings reports, hawkish Fed speak, and lingering recession fears, closing out the 5 trading days with small losses. The Dow Jones Industrial Average slipped 0.23%. The S&P 500 lost 0.1%. NASDAQ fell 0.42%, and internationals were up 0.1%. Stocks hold firm. Stocks traded most of last week around the flat line as investors grappled with several headwinds. The first was a disappointing earnings results, coupled with the absence of earnings guidance from some companies due to an uncertain economic climate. Weak economic data, including declines in housing and leading economic indicators, also weighed on investor sentiment. Finally, multiple Fed officials spoke last week, signaling that inflation remained too high and that future rate hikes may be likely. Underneath the seemingly placid surface of the major market indices, there was substantial price action at the individual stock and sector level. Poor earnings results hit communication services stocks and regional banks, while margin pressures put pressure on auto stock valuations. Housing weakness. 2 housing reports reflected ongoing fragility in the housing market and Fed prevailing economic slowdown worries. Sales of new homes fell 0.8% in March, dragged down by a 5.2% slide in new multifamily home construction. Sales of single-family homes were a bright spot, rising 2.7% to a 3-month high, though that hopeful note was tempered by an 8.8% drop in new application permits, an indicator of future new home building. Existing home sales also suffered a month-over-month decline in March, falling 2.4%. Sales plummeted 22% from March of 22 levels as higher mortgage rates and tight inventories impacted affordability. All right, economic data coming out this week. Tuesday, we have consumer confidence and new home sales. Wednesday, durable goods orders. Thursday, GDP and jobless claims. Friday, personal income and outlays and consumer sentiment. Companies reporting earnings this week. We have a lot. Today on Monday, we had Coca-Cola. Tuesday, we have Microsoft, GE, Verizon, Visa, Alphabet, Google. Or Alphabet is Google. Let's see here. General Motors, McDonald's. I'm loving it. Ameriprise Financial, 3M. Texas Instruments, United Parcel Service, PepsiCo, Next Era Energy, Spotify Technology, and Kimberly-Clark Corporation. Wednesday, that was just all tomorrow. Wednesday, we have Boeing, ServiceNow, Thermo Fisher Scientific, General Dynamics, eBay, Boston Scientific, and Norfolk Southern. Thursday, we have Amazon, Intel, AbbVie, MasterCard, Bristol Myers, Caterpillar, Merck, The Southern Company, Eli Lilly, Northrop Grumman, and Comcast. And to close out the week, on Friday, we have ExxonMobil, Chevron, and Charter Communications. Whew, that was a lot of stuff to read. All right, so that was everything for the weekly update. Let's jump on over to today's market recap. S&P 500 swings between gains and losses as investors eye big tech earnings. All right. On Monday, the S&P 500 fluctuated between gains and losses as investors awaited further catalysts for direction. Big tech earnings, which led the market melt up seen in the first quarter, are due later this week, starting with Alphabet and Microsoft. Tech bulls on Wall Street continue to tout optimism ahead of a flurry of quarterly reports. However, investor sentiment on tech has been muddied in recent weeks as the prospect of a less hawkish than expected Federal Reserve dwindles ahead of the central bank's rate decision on May 3rd. Value sectors of the market, excluding financials, continued to shine, led by energy as oil prices racked up gains. Halliburton, Marathon Oil, and ExxonMobil were amid the sector gains. Ahead of the latter's quarterly results later this week, Goldman Sachs said that while it expects strong operational momentum for ExxonMobil, it recognizes that valuation is, quote, looking less compelling after outperformance, end quote. Financials were trading below the flat line despite a rally in First Republic ahead of the bank's first quarterly results due after the market closes. Coca-Cola slipped despite reporting quarterly results that beat on both the top and bottom lines as higher prices offset rising costs. While Disney Company got its second round of layoffs underway, taking its total layoffs to about 4,000 for the year, still short of the 7,000 planned job cuts announced earlier this year. In other news, Bed Bath & Beyond filed for bankruptcy protection on Sunday after failing to secure enough funds to continue operations, sitting its shares down 33%. Yeah, that was all over the news. I guess it was yesterday. I was seeing that on the financial sites and Twitter and places like that. So, all right, next up, again, like I mentioned earlier, you've probably seen a lot of news about mortgage fees and how those with good credit are going to wind up paying for the scumbags with bad credit. But hey, that's the way it is. Mortgage fees are changing for home buyers next month. Here's what you should know. And this comes from Yahoo Finance. The author is Medora Lee from USA Today. All right, starting May 1st, upfront fees for loans backed by Fannie Mae and Freddie Mac will be adjusted due to changes in the loan level price adjustments. These fees vary from borrower to borrower based on credit scores, down payments, types of homes, and other factors. The changes will affect credit scores and down payment sizes, with people with higher credit scores paying more and those with lower credit scores paying less in some cases. The entire mix of fees based on credit scores and down payments has been updated, and the penalty for having a lower credit score will be smaller than it was before May 1st. These changes are part of the Federal Housing Finance Agency's examination of fees to provide equitable and sustainable access to homeownership and to shore up capital at Freddie Mac and Fannie Mae. The FHFA aims to ensure that all homebuyers have access to affordable credit, particularly low to median income first-time homebuyers. These changes are part of FHFA's efforts to make home ownership more affordable for many Americans. The fees apply to any loan that's guaranteed by either Fannie Mae or Freddie Mac, regardless of the lender. FHFA plans to impose a fee on August 1st for borrowers with at least 40% debt-to-income ratio and a 60% loan-to-value ratio. This fee was originally supposed to take effect on May 1st, but was postponed after pushback from the industry. As a standalone measure, DTI is not a reliable indicator of borrowers' ability to repay, according to the Mortgage Bankers Association. Yeah. And I mean, my thoughts on this, having spent just shy of a decade in credit and collections before moving over into the advisory world, this is not how you do risk-based pricing. You punish the people with bad credit and you reward the people with good credit. And the reason for that is because the people with good credit are more likely to repay their loans. People with bad credit, almost cussed there, are the ones who are typically going to default, and you're going to have to hunt them down. Well, in the case of a mortgage, you're going to have to like evict them and toss them out on their butts for being deadbeats. But this is not how credit should. You should not be rewarding bad behavior. And the fact that the government is, getting involved again in the home buying business for people with less than perfect credit. Don't we remember what happened back in 2008 and 9? I mean, seriously, folks. I mean, people who should not be buying houses, you shouldn't be incentivizing that sort of behavior, because then, 6 months, a year down the road, then they can't pay for it. Because again, the people with bad credit are usually the people who don't show up for work on time. They're usually the first people fired when the economy gets into a pickle. So these are not the folks you want to be giving money to. But hey, what do I know? I'm just some guy sitting here in the mountains. All right, last up is an article from the Mises Wire at Mises Institute. It's titled "Real Wages Fall for 2 Straight Years as Transitory Inflation Turns Stubborn." All right, the U.S. Bureau of Labor Statistics released data showing that price inflation during March had slightly decelerated, coming in at the lowest year-over-year increase in 23 months. The CPI inflation rose 5% year-over-year in March, which is lower than February's year-over-year increase of 6%, and is the 25th month in a row with inflation above the Federal Reserve's 2% target. Price inflation has now been at or above 5% for 23 consecutive months. Month-over-month inflation rose 0.1% from February to March, which is lower than February's 0.4% gain. Growth in CPI inflation reflects the slowdown in energy, gasoline, used cars, and trucks. However, food prices continue to rise at an alarming rate, but even there, increases moderated somewhat. Food at home slowed from a year-over-year increase of 10.2% in February to 8.4% in March. Hey, we're saving money. Inflation in shelter costs increased 8.2% year-over-year in March, which was the highest growth rate since June of '82. The growth rate in average hourly earnings failed to keep up with CPI growth, making it the 24th month in a row that real wages fell. The Biden administration attempted to use slow price growth as an excuse to claim inflation is falling. However, that is not the case. Even with energy prices going down year over year, increases in food and shelter prices ensure that cost of living continues to go up in real terms, especially with 24 months of falling real wages. The core inflation rate of increase fell to 5.6% in March, which is not significantly lower than the 40-year high of 6.6% reached in last September. The Fed refuses to declare victory against rising prices, with New York Fed President John Williams declaring that, quote, inflation is still too high, end quote, on Wednesday. This may prompt the Federal Open Market Committee to raise the target interest rate again at its next meeting. The administration has not been doing any more insightful, with Janet Yellen consistently being wrong. That's about the only place they're consistent. All right, so yeah, it's I know they try to tell us that everything is, it's so much better, but it's not. And my personal belief is I think things are going to collapse at some point here this year. And, like it did back in, I guess, things bottomed out in March of '09. We're probably going to have one of those events sometime later this year. I don't know when. Don't ask me, but be prepared. And that's all I can really say. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. You can book a meeting, drop me an email, or, you can call. Nope, phone's not ringing. All right. Well, I hope everyone has a wonderful evening, and I'll talk to you next time. Adios.